this short video, we will discuss implied volatility risk, which is also known as Vega risk. We will first define implied volatility and then touch on the risks associated with implied volatility. The discussion will move on to examining how a moving market affects a portfolio manager's Vega and how to hedge implied volatility risk. Implied volatility is an estimate by market participants on how much an asset will move over a specific period of time on an annualized basis. Implied volatility is inherent in all options positions and is one of the most important inputs into determining the price and value of an option. Implied volatility is different from historical volatility, as implied volatility is what is expected to happen to the movement of a security, while historical volatility is a measure of what actually happened to a security. Historical implied volatility is a historical observation of implied volatilities that occurred in the past. Implied volatility can be such a strong factor in determining the price of an option that large movements can offset any positive gains relative to directional movements within a security. For example, an investor can own a call option of Apple stock at, say, $600 when the underlying market is at $575 and implied volatility is at 50%. After earnings or some kind of anticipated event, the stock could move to 600 within one day, but could easily be offset by a decline in implied volatility down to 30%. A general rule of thumb that investors should be aware of is that approximately 70% of call options expire out of the money. The reason for this phenomenon is that implied volatility is generally higher than historical volatility, so the actual movements don't actually coincide with what is expected to occur. Implied volatility is traded actively throughout the marketplace. Over the past 10 years, the VIX volatility index has become one of the more popular ways for traders to speculate on the direction of implied volatility. The VIX volatility index, as you can see in this chart, trades like any other type of instrument. The VIX volatility index measures the at-the-money strikes of the S&P 500 index on a dynamic basis as it moves. As the VIX increases, investors are speculating that implied volatility will move higher. The VIX is labeled a fear gauge. Higher VIX levels are generally associated with fear that equity markets will fall. Investors will use the VIX, which is available in futures, options on futures, and in ETF forms, as a way to hedge a portfolio of stocks. Investors will initiate positions specifically designed to take advantage of implied volatility. Implied volatility is a mean reverting process and can be measured to determine if it is rich or cheap on a historical basis. Using historical deviations from a mean, some strategists initiate long or short positions in implied volatility, which is referred to as Vega. Vega is the exposure an investor has to implied volatility. Similar to exposure to outright directional movements, Vega measures how a portfolio of options, or a single option, will perform if implied volatility increases or decreases. Vega is measured as a decimal and is usually converted into a dollar figure. The dollar figure represents the amount of money that will be made or lost for a 1% move in implied volatility. For example, a Vega of $10,000 will theoretically make $10,000 for a 1% increase in implied volatility. As security prices move higher and lower, the exposure an investor has to Vega will change based on the proximity to strikes of the options within a portfolio. This can be known as strike map risk. The closer the underlying price of a strike to a long position, the higher the Vega of that position. Far out of the money options usually have very little exposure to implied volatility. Strike risk, as it pertains to Vega, can be a tricky Greek to monitor. Investors can own a portfolio of options that are both long and short. Despite having an overwhelming number of purchased options, if the underlying price of a security is closer to a short option strike price, the Vega can be negative. Vega risk needs to be hedged with options. Other Greeks, such as delta, can be hedged using outright directional positions, such as stocks or assets themselves, but Vega can only be offset with another option. Most traders will use similar options combining different strikes or offsetting expiration dates to mitigate their Vega risk. Overall, options positions can be complex and hard to understand, and investors speculating in these securities should be aware of the different risks associated with options positions.